All right. Can you all hear me? Hear me clearly? If you can, just type like a 1 in the chat box, and then I'll go ahead and get started. All right, cool. All right, you all can see my screen. I'm assuming as well, right? All right, great. Yeah. All right. Well, let's just hop right into it then. Welcome to the course, guys. Today is going to be mainly a getting started, setting up your charts. We're going to get into a little bit of education as far as like the very basics of Forex. That way you guys understand what it is you're actually doing, what the industry is as a whole. So, you know, it'd be like a little history lesson. You'll learn about pips, margin and leverage, and just like some basic Forex terminology today. You'll learn about the Forex quotes and how to read a Forex quote and things like that. Excuse me. Let's see. All right. So the required material for this course is I've got a PDF of the book Trade for a Living Volume 2 by Alexander Elder. Okay. You're not required to read the full book. No. There's going to be select chapters and select sections that I'm going to have you all read. And the reason behind this is because it's very important to your trade success, because the pieces that I'm picking out, they've got hidden clues and nuggets as far as what you all need to take you all to the next level. I'm going to post the link actually in the hold on. I'm going to post a link in the chat. Give me just a second. Okay. So what I posted in the hold on. Let's go to everybody. So what I posted in the group chat is a link to a Google Drive. It's my Google Drive, and it has the PDF where you can download it. Okay. Um, like I said, it's Trading for a Living Volume 2, so it's kind of updated as far as most recent years and things like that. Got some great nuggets. I would recommend actually, you know, skimming through the whole book itself. But as I said, we're going to focus on a few different things in there throughout the course, not all today or anything like that. The next thing you'll need for this course is an account with JAFX basically. Okay. Again, I posted another link. I'll put it out there again. There it is. So that's the link to JAFX where we're going to open up our demo accounts and things like that tonight. The reason why we chose JAFX is because IMA personally has a the harmonic scanner and things like that are actually going to be, they're set up with JAFX and things like that. So not only that, JAFX offers cryptocurrency trading, which allows you to trade 24/7. Now we'll get into that longer further down the road and things like that. Let's see. Excuse me. All right, let's get back into it. No, go back. All right. The next thing you need is we're going to set up a MyFX book. Why the reason we're setting up this is because one, it's digital tracking for your progress in the contest. Okay. The second reason is because it gives you the ability to set up like a trade journal or let's say like a trade plan, and it tracks it for you basically. Okay. And this is real big, guys. As new traders and things like that, tracking your progress or tracking every trade that you take and writing it down or typing it in somewhere just to basically making a record of it is huge to your success. The reason is because you'll learn from the mistakes you make on the various trades that you take, and I'll go over that in depth later on as well. Um, if you all don't have TradingView, it's free. It's a web price chart. Um, it's optional, but I actually recommend it because it's what I'm going to be using tonight to show you all how to set up your charts, things like that. I'm also going to set it up on MetaTrader, but we're going to be using TradingView for the most part because it's a little bit cleaner. And again, I would also recommend you all get like a composite journal or a composite notebook. This is to track your psychology behind the trades. This goes in hand with the MyFX book. So basically, what you want to get into a habit of is, entering the market based off of technicals, not emotion. All right. In this journal, writing down your psychology of why you entered into the trade, it's going to play out very big for you guys. Okay. What to expect from this course, guys? In the group chats, I had put out a little warning that I was going to be pretty strict. You know what I mean? I'm not going to be like utterly strict, where it's not going to be fun or anything like that or enjoyable. No, but the things that I ask of you all, like I expect to be done. Um, if you're not going to do what I ask of you, then I'm not going to send you the link to this course. You know what I mean? Like if I'm going to do this for you guys, like I expect you all to, you know, be dedicated, basically. You know what I mean? So I thank you all for being on here tonight. And, commit yourselves and applaud yourselves and things like that, because that's a big step. Treat this like a college course. You know what I mean? Like I said, you spent money to be here, guys. Like you all paid for IML and things like that. Like this is an investment to your education. My biggest advice to this is be patient when learning this. Okay. It takes 4 years plus to be a nurse, right? And they have to learn that skill, right? Okay, so it's going to take you all a while to learn this skill because that's what you're actually learning. It's a skill set. There is some homework. You're going to be required to mark up some charts, a little bit of reading, and doing like a little essay of, as far as like not a long ass essay or anything like that, but a little monologue as far as what is your why and what makes that your why. Okay. Some disclosure is like, guys, what I'm going to teach you isn't the holy grail of all trading. You're going to lose sometimes and things like that. So expect that. Don't expect to just get it and then just, oh, you're never going to lose. No, you're going to lose some, guys. Okay. So this isn't the holy grail, but this is an educational course on Forex as a whole and technical analysis strategy that I personally use and things like that. Okay. And again, this is not to be confused with financial advice. Okay, I'll get that as well. All right, so let's hop right into it, guys. All right, so what exactly is Forex? The simple answer is money. Because you're not buying anything physical, Forex trading, it can be confusing. Think of buying a currency as buying a share of a particular country, kind of like buying stocks of a company. The price of the currency is usually a direct reflection of the market's opinion on the current and future health of its respective economy. In Forex trading, when you buy, say, let's say the Japanese yen, you are basically buying a share of the Japanese economy. You are speculating that the Japanese economy is doing well and will even get better as time goes up. So that's why we buy. Now, once you close your order or you sell those shares back to the market, hopefully that's where you end up with a profit. Okay. So basically, the exchange rate of a currency versus the other currencies is a reflection of the condition that of that country's economy compared to the other country's economy. For instance, the euro versus our United States dollar. That's Europe's economy versus our economy. Okay. If you all have ever traveled or anything like that, you have most definitely seen this currency exchange counter at one place or one time or another at an airport. And this is basically what we're doing, guys, except for without the middleman of this counter person. Believe it or not, when you all exchange currencies like this at the Travelex, they're making a profit. They're your broker, basically, you're using. So look at them as like a mini broker. Okay. Some major currencies that we usually trade. You've got the United States dollar. Okay, its nickname is the buck. It's got a few different nicknames to it actually. You've got the euro, the eurozone. Its nickname is the fiber. The Japanese yen, of course, it's just yen. There's also a Japanese won as well, and we'll get into that later down the road as well. We've got Great Britain pound, nicknamed the cable. Switzerland's is the Swiss franc, Swissy. Canadian dollar is the loonie. The Australian dollar is the Aussie. Let me move this. And then you have the New Zealand dollar, and that's the Kiwi. Buying and selling of a currency. Forex trading is the simultaneous buying of one currency and the selling of another. Currencies are traded through a broker or a dealer, quote unquote, like the Travelex, and are traded in pairs. For example, the euro versus the dollar. That's EUR/USD, or the British pound in the yen. That's GBP/JPY. When you trade in the Forex market, you buy or sell in currency pairs. Now, imagine each currency pair constantly in a tug of war with each other on the side of the road, basically. Okay, the exchange rate fluctuates. Okay, based on which currency is stronger at the moment. Again, here's the major currency pairs. All right, so Forex is a rather huge, or actually it's the biggest financial market in the world, basically, okay? Unlike other financial markets like the New York Stock Exchange or the London Stock Exchange, the Forex market has neither a physical location or a central exchange. What that means is it's not confined to just one country, okay? It's not specialized to just like China. It's not specialized for just London or just United States. The Forex market is considered an over-the-counter or interbank market due to the fact that the entire market is run electronically and within the network of banks continuously over a 24-hour period. This means that the spot Forex market is spread all over the globe with no central location. So basically, wherever you have internet, trades can be taken, okay? The Forex market is by far the biggest and most popular financial market in the world. It's traded globally by a large number of investors and also a few organizations as well. All right, so here's our New York Stock Exchange. What this graph depicts is the size or the comparison as far as how much money is generated on a daily basis. All right. Our New York Stock Exchange only generates about 28 to about $35 billion in a day. The equities markets, which is like the indices of NASDAQ and things like that, they generate $191 billion a day. But notice over here, you've got the Forex market. It's in the trillions. So these three markets right here, they're like dwarfs compared to the Forex market. And this is why Forex is you know, the king honcho of trading and things like that. All right, now in the spot market, currencies are traded immediately or on the spot using the current market price. What's awesome about this market is its simplicity, liquidity, tight spreads, and around-the-clock operations. Basically, when this market's open on Sunday, 5 p.m. Eastern Standard Time, you're able to trade 24 hours a day, all the way till Friday, 5 o'clock a day. Okay. And then, of course, it's very easy to participate in this market since accounts can be opened with as little as $50. It's not recommended as a new trader, actually. It's recommended you open up a demo account to practice, and then, you know, you can start with a couple $100 on your first account. Okay, so why do people trade the Forex market? It cuts out the middleman as far as like Edward Jones, Charles Schwab, and investment companies and things like that who basically accept your money. They'll trade the money for you, keep the larger percentage of the two, and then give you a small thing. That's not. I'm not saying that's a bad thing, guys. But if I've got a way where I can learn, a skill, the same thing that these guys are doing to make the money, why would I not do that? You know what I mean? Keep your money. Um, Spot currency trading eliminates the middleman, of course, and allows you to trade directly with the market, responsible for the pricing on a particular currency pair. Another reason why is there's no fixed lot size. In the futures market, a lot or contract sizes are determined by the exchanges, and a standard size contract for silver future is 5,000 ounces. Okay, that's just some little extra information. In the spot forex, you determine your own lot size, and a lot. What I'm referring to it as your own lot. Basically, that's your position size or your trade size. This allows traders to participate in accounts again as small as $50. It's not recommended. And depending on the broker you choose, you'll have some low transaction costs. The retail transaction cost is usually the bid-ask spread, and we'll go over that, of course, here in a little bit. And it's usually less than 0.1% under normal market conditions. At larger dealers, the spread could be as low as 0.07%. And of course, this depends on your leverage and all that will be explained later. Forex markets is a 24-hour market. There's no waiting for the opening bell. Basically, like I said earlier, Sunday 5 p.m. you're able to trade all the way to Friday 5 p.m. Okay. This is awesome for those who want to trade on a part-time basis because you can choose when you want to trade. Basically, morning, noon, night, during breakfast, or in your sleep. I typically try to trade during my sleep. Yeah, Ray, we'll be doing some. I'll be doing some trading actually. I'll call out some signals for the compound plan. Another reason why people trade the forex market is because you can't counter. No one can corner the market. Basically, no one can bully the market, and there's a little bit of market manipulation, but for the most part, it's almost a bare minimum because it's so big. Okay. The forex market is so huge and has many participants that no single entity, not even a central bank or mighty technology itself, can control the market price for an extended period of time. Now, the central banks and things like that, they can stop hunt. They can create large bursts in price or large movements in price for a few hours, but it's not going to be sustained, and that's when the retracements and things like that come in handy. We'll go along with that later on as well. Another reason why folks trade forex is because the leverage offered. In stocks, guys, the offered leverage is 10-1, I believe, which is very, very crappy. It means you have to have a nice chunk of change, basically. Not only that, stocks, you're usually going to, open a position and hold that position for weeks, months at a time. Okay. With forex, a small deposit can control a much larger total contract value, and that's due to leverage. And this is called margin trading. Leverage gives the trader the ability to make nice profits and at the same time keep, risk capital to a minimum. For example, a broker may offer, 50-1 leverage, which means that a $50 margin deposit would enable a trader to buy or sell $2,500 worth of currencies. With the $500 account, one trade could hold, $25,000 and so on, basically. Okay, and that's 50-1 leverage. Now, while this is all gravy, let's remember that leverage, guys, is a double-edged sword. So without that proper risk management, this high degree leverage can lead to large losses. But on the plus side, it can give you some large gains as well. Another reason is the high liquidity. Because the forex market is enormous, it's extremely liquid. This is an advantage because it means that under normal market conditions, with the click of a mouse, you can instantaneously buy and sell at will, and there will be someone on the market willing to take the other side of that trade. You're also never stuck in a trade. You can, get out of the trades whenever you want to at the click of a button, or you can set a stop loss order or sell limit order and all that stuff. There's also low barriers to entry. meaning there's not too many obstacles besides maybe your internet connection or anything like that. It doesn't really require a lot of capital nowadays, thanks to the internet, to even get started. All right, because these online brokers, they're offering now these mini and micro accounts. Some of them actually will let you deposit as low as $10, honestly. Let's see. Now, who trades Forex? It's essential for you to understand the nature of the spot Forex market and who the main Forex players are and how they operate. Okay. Until the late 1990s, only big guys could play this game. Basically, the initial requirement was that you could trade only if you had about 10 to 50 million bucks to start with. You had to take that to the bank, or you had to take that to your broker. You was on the phone calling your broker, telling him to buy, sell here, and that took a lot of time and execution out the actual trade and order itself. Okay. Forex was originally intended to be used by bankers and large institutions, and not by us retail traders. But however, because of the rise of the internet, online Forex brokers are popular now. They're popular. So who trades? Top banks. Since the Forex spot market is decentralized, it is the largest banks in the world that determine the exchange rates. Okay. Based on the supply and demand for the currency, they are generally the ones that make the bid and ask spread, that we all love or hate, for that matter. These large banks, collectively known as the interbank market, take on a ridiculous amount of Forex transactions each day for both their customers and themselves. A couple of these super banks include like Citibank, your JP Morgan, UBS, Barclays Bank, the Dutch Bank, and HSBC. You can say the interbank market is the foreign exchange market based out of these banks. And just touching on these banks a little bit like that, over the past several years, several of these banks have been hit with those fines for market manipulation. Okay. Businesses and corporations also trade Forex. Companies take part in the foreign exchange market for the purpose of doing business. For instance, Apple must first exchange our dollars for the Japanese yen when purchasing electronics from Japan. Okay. Since the volume they trade is much smaller than those in the interbank market, this type of market player typically deals with commercial banks for the transactions. You've got like mergers and acquisitions. M&A between larger companies can also create currency exchange fluctuations. In international cross-border mergers and accusations, a lot of currency conversations happens that could, basically manipulate the price as well. You got your governments and your central banks now, such as your European Central Bank and the Bank of England and our own Federal Reserve are regularly involved in the Forex market as well. Just like the companies I mentioned before, national governments, though, participate in the Forex market for their operations and international trade payments and handling of their foreign exchange reserves. Meanwhile, the central banks affect the Forex market when they adjust interest rates and control the inflation. All right. By doing this, they can affect the currency valuation. There are also instances when central banks intervene directly or verbally in the Forex market when they want to realign exchange price. So this is when like Yellen comes on and gives like a little speech or something like that. And based off that speech alone, so this is called fundamental analysis or news release. You're able to basically take a trade off of it or, set aside and things like that. So like sometimes they'll come up there and say just key words to the media that will get the market in a frenzy. Who else trades Forex? You and us. We're the Forex market. We're Forex market players, the retail traders. Okay. Now here's the history of Forex. At the end of the World War II, the world was experiencing so much chaos that the major Western governments felt the need to create a system to stabilize the global economy. This is the spawn or the start of the Bretton Woods system. Now that's the agreement set the exchange rate for the US dollar against gold, which allowed other currencies to be pegged off the US dollar. This stabilized exchange rates for a while, but as the major economies of the world started to change and grow at different speeds, the rules of the system soon became obsolete and limiting a little bit. And then soon enough, come 1971, the Bretton Woods Agreement was abolished and replaced by a different currency valuation system. With the United States in the pilot seat, the currency market evolved into a free-floating one where exchange rates were determined by supply and demand, basically. At first, it was difficult to determine fair exchange rates, but advances in technology and communication eventually made things easier, such as the internet. Once the 1990s came along, thanks to computer nerds and the booming growth of the banks and the booming growth of the world, banks began creating their own trading platforms. These platforms were designed to stream live quotes to their clients so that they could instantly execute trade themselves and not have to call their broker. Meanwhile, some smart business-minded marketing machines introduced internet-based trading platforms for individual traders. Known as retail Forex brokers, these entities made it easy for individuals to trade them by allowing smaller trade sizes. Now, unlike in the interbank market where the standard trade size is 1.00, that's a standard lot size, which is 1 million units. Retail brokers allow individuals to trade as little as 1,000 units, or the micro lot size of 0.01. Again, yes, it's true that the Forex market is open 24 hours a day, but that doesn't mean it's always active the whole day, guys. Okay, so understand that. There's periods of rest and there's periods of a trend. You can make money trading when the market moves up, and you can even make money when the market moves down. But you'll have a very difficult time making money when the market isn't moving at all or it's moving sideways. Okay. Before looking at the best times to trade, we must look at what a 24-hour day in the Forex market world looks like. The Forex market can be broken up into 4 major trading sessions. You've got your Sydney session, which is what we're in right now, and you also have the Tokyo session, which we're in right now. Here come 9 o'clock, I believe. You've got the London session and then the New York session. Those are the 4 major sessions. We typically trade the London and the New York session, which is I'll give you the time share in a second. Again, so Sydney opens at 6 p.m. All right, closes at 3 a.m. Tokyo opens at 7 p.m., closes at 4 a.m. London opens at 3 a.m., closes at 12 p.m. New York opens at 8, closes at 5. Now notice some of these overlap. All right, now when they overlap, those are some of the best times to trade. This is the hours in the winter. This is just adjusted for daylight savings and things like that. Okay. Now, the actual open and close times are based on the local business hours. What that means is the actual open and close of your broker is based on where your broker is at. And also, it's going to vary during the months of October and April, of course, as some countries shift to daylight savings time. The day within each month that a country may shift, the day within each month that a country may shift to or from daylight saving time also varies. And you can see that in between each Forex trading session that there's a period of time when the 2 sessions overlap at the same time. During the summer from 3 to 4 Eastern, the Tokyo session, the London session overlap. During both summer and the winter from 8 to 12. The London session and the New York session overlap, okay? Naturally, these are the busiest times during the trading day because there's more volume and the two markets are open at the same time. This makes sense because during those times, all the market participants are wheeling and dealing, looking for the trade. They're scouting out their orders and things like that, okay? Let's see. This chart shows the average pip range based on the sessions. So Tokyo session, we don't really trade too much because there's not too much movement. I'm not gonna say you can't catch a good trade setup, but London and New York, notice just the difference. Okay, and that's why we trade London and New York. All right, so just a second, guys. opening of the Tokyo session is at 12 a.m. And that starts the Asian session basically. The main market participants during the Tokyo session are your commercial companies who are exporting and your central banks. Remember, Japan's economy is heavily export dependent, and with China also being a major trade player, there are lots of transactions taking place on a daily basis. Liquidity can also be very thin in the Asian session. There will be times when trading during this period will be like fishing. Of course, like I said, it's usually a period of rest. It's more than likely that you will see stronger moves in Asia Pacific currencies like AUD USD, NZD USD, as opposed to non-Asia Pacific pairs like the British Pound USD. So basically, in Asian session, if you're going to trade it, focus on your JPYs, focus on your New Zealand dollars, whatever's open or whatever country that's in that market, basically. Most of the action takes place early in the session and when more economic data is released. And moves in the Tokyo session could set the tone actually for the rest of the day, because the Asian session is the beginning of a new trade day. So if that's the case, sometimes Asian session will set the high or low for that day. And again, here's the pip range. So if you're going to trade Tokyo, I would say focus on like GBP JPY, Euro JPY, AUD JPY, AUD USD, something like that. All right, on the London session, this London session crosses with the two other major trading sessions, and with London being such a key financial center, a large chunk of Forex transactions take place during this time. This leads to high liquidity and potentially lower transaction costs, example like lower pip spreads and things like that. PG, I'll show you here once I show you the charts what I mean by stating the high or the low for the day. It's it's a lot. It's not really complicated. I'm gonna show you. Due to the large amount of transactions that take place, the London trade session is normally the most volatile session. Okay, and that's why the pip range is so broad or so much greater than like the Asian session. Most trends begin during the London session at the London Open, and they typically will continue until the beginning of the New York session. Now that's big, guys. That key piece right there is how I typically trade. All right. I usually have an order or a pending order set by 12, 11 p.m. and then I'm in bed. I'm asleep. I'll wake up, 6, 7 in the morning, check it, and I'll reevaluate the trade at that time. If I think it's going to continue in my favor, I'll just, I'll use a trailing stop loss or take profit, something like that. Again, volatility tends to die down in the middle of the session as traders often go off to eat lunch and before waiting for the New York session to begin. Trends can also sometimes reverse at the end of the London session, okay? And that's why you're either going to take profit come the New York session or you're going to reevaluate. And again, here's the pip range of the London session. The New York session, there is high liquidity during the mornings as it overlaps with the London session. Most economic reports are released near the start of the New York session. So remember, about 85% of all trades involve. Remember, about 85% of all trades involve the dollar. So whenever big-time U.S. Economic data is released, it's got potential to move the market greatly on a lot of pairs. Once the London session basically closed shop, liquidity and volatility, tends to die down. This is around afternoon, in between 12 and 1. There is very little movement Friday afternoon as the Asian traders are out, singing the karaoke bars, and the London traders are headed to the pub to watch the soccer match. Basically, what this is all telling you guys is like, there's a timing element behind this. You see what I'm saying? So, and we'll get into that as well. Also on Fridays, there's a chance of reversals in the second half of the session as U.S. traders close out their positions ahead of the weekend. And that helps out with broker fees and things like that. Here's the pip range for the New York session. All right, so when are the best times to trade, guys? You've got your London open. You've got your London to New York overlap. Let me put the times. London open, again, London opens at 3 a.m. Eastern Standard Time. So if you're going to trade London open, you want to be looking at charts by 1 o'clock at the latest. You want to have a position in by, let's say, 3 o'clock, okay? London to New York overlap, that's from the New York open at 7, 8 a.m. Eastern Standard Time, all the way to about noon. This is when the real shebang begins. The London, New York overlap, that's a heavy, traded time period, basically, okay? It's the busiest time of the day. It's traded from the two largest financial centers, London and New York, begin duking it out, basically. It is during this period where we can see some big moves, especially when news reports are released. The markets can also be hit late by news coming out of Europe as well during the New York session. If any trends were established during the European session, we could see potential trend reversals here or potential continuation as U.S. traders decide to jump in and establish their positions after reading up of what happened earlier during the London session. Again, fair warning, watch out. At the end of this session, some European traders may be closing their positions, which could lead to, a slower market or choppy moves. So here's the chart, guys, of the major currency pairs over here on the left, the day at the top, and their average pips that they move on that day. So looking from Sunday to Friday, as you see, let's just use Euro for the example. Sunday, Monday, they're slow. Sunday, you don't even want to trade. Monday, it's picking up, but Tuesday, Wednesday, Thursday, sometimes even on Friday, you're in there. So that's some nice movement. And that's typically the trend, with the rest of these pairs. All right. So the best overtimes to trade is when there's two sessions are overlapping. There are also some times when major news events come out to have potentially spark some volatility and directional moves. And we're able to spot that by the technical analysis that I'm going to be teaching you guys. The European or the London session tends to be the busiest out of the three, and the middle of the week typically shows the most movement as the pip range widens for most of the major currency pairs. The worst times to trade, you've got your Sundays, because everybody's either recuperating from the weekends or just resting, basically. You've got, excuse me. You've got Fridays, because everybody's anxious to get off work, so liquidity is going to die down during the later part of the U.S. session. You've got your holidays, and then in between 5 and 8 p.m. Eastern Standard Time. In between 5 and 8, that's like a market rest period. Okay, like I said, I very highly recommend not to trade during that time frame. Now, come 9 o'clock, you can trade whatever, do whatever you want. All right, so now, how does one make money? In the Forex market, you're buying or selling currencies, okay? So placing a trade in the foreign exchange market is simple. The mechanics of a trade are very similar to those found in other markets. So if you have any experience in trading, then you'll be able to pick up on it pretty quickly. The object of Forex trading is to exchange one currency for another in the expectation that the price will change. So if you're going to buy something, you expect the price to go up. If you're going to sell a currency, you expect the price to go down, okay? Here's an example. You purchase 10,000 units, or you use the micro lot size or mini lot size of 0.10, okay, of the Euro USD exchange rate at $1.18. All right. 2 weeks later, you exchange your euros back to the US dollar, or you close your order basically at the exchange rate of $1.25. So if you bought at $1.18 and you closed at $1.25, that's a lot of pips, guys. All right. That's 700 pips right there. Okay, so that's why you earn a profit of $700. All right, here's the math on it. And that's how we're able, that's how we make profit, guys. I'll show you on the charts as well. Now, reading a Forex quote, this is big for you all to understand as far as, because now you're getting into looking for like the spread of a currency pair and things like that. Currencies are always quoted in pairs such as GBP, USD, or USD or JPY. The reason they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling another. The first listed currency to the left of the slash is known as the base currency. And the picture to the right, that's the British pound. The second one is called the counter or the quote currency. And the picture to the right, United States dollar. When buying, the exchange rate tells you how much you have to pay in units of the quote currency to buy 1 unit of the base currency. So in the example, you have to pay $1.51 and some odd decimals to attain one, basically 1 pound, or 1 British pound. All right. But when you're selling, the exchange rate tells you how many units of the quote currency you will get for selling the base currency. So for selling 1 pound, you're going to get $1.51. Does that make sense? I hope. Bid ask spread. So this picture to the right is giving you like a generic picture of the MetaTrader 4 buy and sell buttons that you'll be pressing. Okay. All Forex quotes are quoted with 2 prices, the bid and ask. For the most part, the bid is lower than the ask price. The bid is the price at which your broker is willing to buy the base currency in exchange for the quote currency. This means that the bid is the best price available at which us as the traders will sell to the market. The ask is the price at which your broker will sell the base currency in exchange for the quote currency. This means that the ask price is the best available price. Okay. So again, to clarify that, buy is a bid, sell is ask. The difference between the buy and sell price or the bid and ask price, that's your spread. On the Euro USD quote example, the bid price was $1.34, some odd change or whatever. And the ask price is $1.34,588. Look at how this broker makes it easy for you to trade your money away, basically. If you want to sell euro, you click sell and you will sell euros at $1.34. If you want to $1.34,568. If you want to buy the euro, you click buy and then basically you buy the euros at whatever quote it's at that time you press the button, basically. Okay, so let's tie this all together real quick. Left side of the slash is the base currency. Right side of the slash is your counter currency. Left side is the bid sell price. Right side is the buy ask. Hold on, no. Left side is your bid price. Right side is your ask price. Okay, the ask price is your sell. The bid price is your buy. Think of it as like an auction. You put a bid in at an auction. The person who's selling the stuff puts in an ask price at an auction. All right. These right here are your pips. All right. So the spread, to find out how big or how wide the spread is, you take your ask price and you subtract the bid price. And notice from 1053 to 1051, it's only 2 pips. So your spread is 2 pips. All right, now let's get to some Forex lingo, okay? So when you go to the grocery store and you want to buy an egg, you can't buy just a single egg. They come in dozens or lots of 12, okay? In Forex, it would be just as foolish to buy or sell 1 euro. So they usually come in lots, okay, of 1,000 units of currency, which is the micro lot size of 0.01, 10,000 units, which is the mini lot size of 0.10, or 1,000 units, which is the standard lot size of 1.00. And that's going to depend on your broker and the account type you have. And then trading on margin is simply trading with borrowed capital or using leverage from your broker. And this is actually how you're able to trade or open, you know, 1,250 or $50,000 positions with as little as $25 or $1,000. It's because of the leverage. All right, so margin. You believe that signals in the United States in the market are indicating that the British pound will go up against the United States dollar. You open one standard lot size, okay, 1.00 or 100,000 units of GBP USD, buying the British pound at 2% margin and wait for the exchange rate to climb. When you buy one lot size of the British pound at a price of $1.50, you are buying 100,000 pounds, which is worth 150,000 US dollars. Okay. If the margin requirement was 2%, then $3,000 would be set aside on your account to open that trade. So basically, you would have to have an account size higher or with the equity more than $3,000 to be able to buy a standard a standard trade, basically. And that also, again, that also depends on what leverage you're using and things like that. Okay. So let's say if your predictions come true and you decide to sell and you close your position at 50 pips above it, then you earn $500. So here's what we did: bought 1,000 pounds at an exchange rate of $1.50. You blink for 2 seconds, GU exchange rate rises to $1, rises 50 pips. Basically, you close your order. You gained 50 pips. Remember, 50 pips at a standard is $500. All right, so pips. What a pip is a unit of measurement that expresses the change in value between two currencies. If Euro USD moves from $1.1050 to $1.1051, that 0.0001 USD rise in value is 1 pip. Now, some of these brokers will go out to the 5th place. All right. A pip is usually the last decimal place of a quotation. And again, most pairs go out to 4 decimal places, but there are some exceptions, like the Japanese yen pairs. They only use like 2 or 3, depending on your broker. There are brokers that quote currency pairs beyond the standard 4 and 2, and they'll use 5 and 3. They are quoting the fractional pips, which are called pipettes. For instance, if GBP USD moves from 1.30542 to 1.30543, that's only a 0.00001 move. That's not a full pip. That's a pipette. All right. The value of a pip also varies based on the currency. Now, here's the little thing behind leverage. Think of your broker as a bank who basically fronts you $100,000 to buy currencies. All the bank asks from you, though, is that you just give it $1,000 on a good faith deposit, which is for them to hold, but not necessarily keep. Okay. It sounds good to be true, but that's basically what, trading using leverage works, or trading on margin works with Forex. The amount of leverage you use will depend on the broker and what you feel comfortable with. Typically, we use 500 to 1, which is significantly high, but that's what allows us to trade with, the less equity. Typically, the broker will require a trade deposit, or known as account margin or initial margin. Once you have deposited your money, you will be able to trade, basically. If the allowed leverage is 100 to 1, or a 1% position is required, and you wanted to trade a position, or you wanted to trade a lot size of 1.00 or a standard lot size, but you only have $5,000 in your account, that's no problem. Your broker is just going to set aside $1,000 as the quote unquote down payment, and that's where the margin percent and the margin number on your MetaTrader 4 comes from. Okay. Any losses or gains will be deducted or added to the remaining cash balance on your account. The minimum security margin for each lot size will vary basically from broker to broker. In the example above, the broker required a 1% margin. This means that for every standard lot size, the broker wants $1,000 for the deposit. All right, so here's the lesson review, guys. The major and minor currencies, the eight most frequently traded currencies are the USD, dollar, the euro, Japanese yen, British pound, Swiss franc, Canadian dollar, New Zealand dollar, and Australian dollar. Okay, those are the majors. All other currencies are referred to as minor currencies, like your shoot. Anything basically outside of those. There's a ton of them. The base currency is the first currency in any currency pair. The currency quote shows how much the base currency is worth and measured against the second currency. For example, United States Swiss franc rate equals $1.63. Then one United States dollar is worth $1.63 Swiss franc, basically. Got a question? Yeah, Kevin, this is being recorded. In the Forex market, the US dollar is normally considered the base currency for quotes, meaning that quotes are expressed in the unit of $1 US per the other currency quote. All right. The primary exceptions to this rule again are the British pound, the euro, the Australian dollar, and the New Zealand dollar. They also have minors or exotic pairs as well. Quote currency. The quote currency is the second currency in any currency pair. This is frequently called the pip currency, and any unrealized profit or loss is expressed in that currency. What's a pip? A pip is the smallest unit of price for any currency. Nearly all currency pairs consist of 5 significant digits, and most pairs have the decimal point immediately after the first digit, like, euro USD equals 1.2538. In that instance, a single pip equals the smallest change in the 4th decimal place. Therefore, if the quote currency of any USD pair, then 1 pip is usually equal to 1/100th of a cent. Notable exceptions are pairs that include the Japanese yen, where the pip equals 0.01. Pipette is 1/10 of a pip. Some brokers quote the fractional pips or pipettes, some of them don't. Your bid price is the price at which the market is prepared to buy at a specific currency pair in the Forex market. At this price, the trader can sell the base currency. It's shown on the left side of the currency quote. For example, in the GU, the bid price is the 18812. This means that if you sell 1 British pound for $1.88, the ask price or the offer price is the price at which the market is prepared to sell. All right, and it's on the right. All right. The spread is the difference between the bid and the ask price. The big figure quote is the dealer expression referring to the first few digits of an exchange rate. These digits are often omitted in dealer quotes. That you don't really have to know too much about that. It's some extra information. Well, for example, the USD JPY rate might be 118.30, 118.34. That's your bid ask, but will be quoted verbally without the first 3 digits as 30.40. 30.34. Basically, they're taking anything behind the decimal, and they're using it. That's your big figure quote or the dealer expression. The quote convention. Your exchange rates in the Forex market are expressed using the following format. Basically, you've got your base currency on the left, your quote currency on the right, the bid prices on the left, your ask prices on the right. What's margin? Margin is when you open a new margin account with a Forex broker, you must deposit a minimum amount with that broker. This minimum varies from broker to broker and usually can be as low as $10 or $100 and as high as $100,000. Each time you execute a new trade, a certain percentage of the account balance in the margin will be set aside for the initial margin requirement for that new trade. The amount is based upon the underlying currency pair, its current price, and the number of units or the lots traded. The lot size always refers to the base currency. Let's say you open up a mini account which provides 200 to 1 leverage or 0.5% margin, basically. Let's say one mini lot equals $10,000. All right. If you were to open one mini lot or 0.5 in this instance, instead of having to provide the full 10,000, you would only need 50 bucks. And here's the math behind it. $10,000 times the 0.05%, that's 50 bucks. So with a $100 account, basically with 200 to 1 leverage, you're able to use the mini lot size. Leverage is the ratio of the amount of capital used in a transaction to the required security deposit, okay, or the margin. All right. It's the ability to control large dollar amounts of a security within a relative small amount of capital. Like I said earlier, this is what allows us to, trade in the Forex market with smaller account sizes. Of course, leverage also varies drastically with different brokers, ranging from 2 to 1 all the way to 500 to 1. In the United States, the CTFC only really, or regulated brokers are only allowed to offer U.S. clients 50 to 1. Some exceptions go all the way up to 100 to 1, which it's not really good. And that's why a lot of people are attracted to offshore brokers. All Forex traders, and we do mean all, lose money in some trades. Okay, guys, this is actually what to expect out of Forex trading. All right, I'm going to give it to you real raw. 90% of traders lose money. The reason why we lose money is largely due to the lack of planning, the lack of training, the lack of discipline, and basically poor money management rules. If you master planning out your trades, you master training, you master a discipline of sticking to a trade plan, and you master some money management rules, guys, you will have great success in this industry. If you hate to lose, or if you are a super perfectionist, you'll also probably have a hard time adjusting to trading, because all traders lose a trade at one point or another. All traders, guys, go through a period of loss. And when I say a period, guys, on average, all traders will lose 3 months out of the year. Now, it may not be 3 months consecutively, but you can lose 2-3 months, or 2-3 weeks in a row. You can lose 2 days in a row and then have a perfect month after that. It's going to vary, guys. So when you're losing in a streak, you have to know how to control that. Don't get upset. Just understand, just some things are just going on in the market that's just not ideal for us to trade. And you'll become aware of when you want to trade, how you want to trade, what to trade, what's going on in the market. You'll become more aware of all that the more detailed you keep your journal. All right? Don't expect to start an account with a few $100s and expect to become a gazillionaire either. That's not realistic, guys. This is not a get-rich-quick thing. Yeah, you can make a shit ton of money with it real quick if you have a nice account, don't get me wrong, and you catch the right setup. But don't expect that every time, guys. This is not a get-rich-quick scheme, okay? You can make some money. The Forex market is one of the most popular markets for speculation due to its enormous size, liquidity, and tendency for the currencies to move in strong trends. You would think traders all over the world will be making a killing, but again, success has been limited to a very small percentage of traders because they have mastered the planning, they've mastered training, they've mastered discipline, and they've mastered their money management rules. All right. The problem is that many traders come with the misguided hope of making a gazillion bucks, but in reality, they lack the discipline required for really learning the art of trading. Okay. Again, it's not a get-rich-quick scheme. It's a skill set that you're learning, guys, and it's going to take time, all right? Like I said, think of it like a college course. You have to go through college to get that skill, to be that doctor, to be that lawyer, to be that nurse, to be that engineer. The truth is that even expert traders with years of experience still encounter periodic losses, all right? So, like, again, if you go on a losing streak, it's okay. Calm down. We all do. All right. There are no shortcuts to Forex trading. Drill this in your head. There are no shortcuts to Forex trading. I don't care if it is swipe trades or not. Swipe trades is probably about the closest shortcut you'll get to basically, trading, because somebody else is doing the work for you. And even they will go on losing periods. And that's when you have to control and follow your money management rules. It takes a lots and lots of practice and experience to master this, guys. All right. And so you're going to put your time into it. Like, if you want to succeed with this, guys, you can't treat it like a hobby. You can't really treat it like just a part-time thing you just want to do just for here and there. I mean, you're not going to have longevity in this industry doing that. Okay. There is no substitute for the hard work or the deliberate practice and the diligence that you're going to have to put forth to basically succeed in this. Okay. That's the end of the PDF. So what I'm going to do now is go on the charts. We're going to open up our demo accounts. We're going to connect them to the MyFX book. And then we're going to set up the charts and a couple of the tools, and then we'll wrap it up. Okay, so probably about 1 more hour, if that. Let me see. Y'all have any questions so far? All right. Let's see. Kelly Edwards, you're unmuted. Go ahead, ask your question. Kelly? Hello, hello. Or if you all have any questions, type them in the chat box. But I saw Kelly and PG raise their hands, so let's keep on trucking. Let's see. All right. Share the screen. So the first thing you want to do, guys. Let me share my screen. All right. So now we're going to open up our demo accounts or our practice accounts, guys. Okay. I'm going to do this step by step as if I've never really done it. Right now, I just want you guys to basically watch what I'm doing, so that way you are familiar of what to do once we're off the call or once we're done. Okay. Again, this is recorded, so you'll be able to watch it later. But you'll click on that JaxFX link I sent you, or you go to jafx.com. It's going to pull up this little website. I got you, PG. It's going to pull up this little website, and then you can go to open an account. This is how you open up a live account, things like that. But for the demo purposes or for the contest and things like that, we're going to do a demo account. So you're going to just click on Web Trader. The Web Trader is going to be, oh, let me log out. All right. So this is the web platform of the mobile MetaTrader 4. All right. So what you want to do is, once you click on Web Trader, come to File, go to Open up a demo account. You're just going to type in your name, email address, account type, and your deposit, guys, is going to be $500. Your leverage is going to be 500. Okay. From there, just hit next. Once it shows you your login and your password, jot this down, screenshot it, take a picture of it. Yeah, let me take a picture of it, because that's your login for the MetaTrader 4 that you're going to now download. Okay, just a second. All right, so hit complete. The Web Trader is automatically going to log you in. To download the MetaTrader 4, go back to JAFX, click on MT4, and it's going to start downloading. All right. Once it's done downloading, just open it up. We'll click yes. Yes, agree to the terms. Next. You can actually exit out this pop-up that pops up. That's just the homepage for MQ4L. It'll download the files, hit finish. Yeah, Kelly, I'll put the slideshow out as well. All right. So once it opens up, this is what you're going to see. All right. It's basically a brand new MT4 terminal. Okay. So you're going to click on the Jax Demo 3, hit next, existing trade account. Now this is where we enter the information that you took a screenshot of or that you jotted down when we opened the demo account. Okay. Let's see. All right, so once you log in, you'll hear the little sound.
Incoming mail.
All your alerts are popping up. It's going to show you over here on your navigation, showed your accounts, what you're logged into, and things like that. You can X out of that. All right, here's your market watch. This shows you the currency pairs. All right. Over here, to see everything you're able to trade, you need to right click on it, go down to show all. All right, so right click on it, go down to show all. And then of course, that's going to give you all the indices, some stocks, and also cryptocurrencies. All right. Here's your cryptocurrencies down here. All right, so you can exit out of that or you can keep it up. That's your market watch. You can hit Control M and it goes away. Hit Control M, it'll come back. Excuse me. Just a second. Hold on just a second. Ray, to put up 4 charts, let's put this down here. You see this button right here? It's going to, basically tile any charts you have open. If I open up any more, new chart window, hit that tile button, it's going to tile it some more basically. All right, so, excuse me. So now that we have the demo accounts open, we're going to set up our chart, okay? So for this purpose, we're going to use the Euro USD just to set it up, okay? We're going to set up the template. It's to the right of the minus sign. The minus, what is that called? Magnifying glass. It's to the right of it. All right. Notice on this chart though, you've got like a grid in the background. If you don't like that grid, you can hit Control G and it'll go away, or you can right click and click on grid and it goes away. I typically like it without the grid. Okay, the first, hold on real quick, got a question. Maybe you did. Okay. Now what we're going to do is basically set up a couple of indicators for you all to use. The first one we're going to add is we're going to add one moving average. All right. So in order to do that, we come up here to this page with the green plus and we click on it. We go down to trend and click on moving average. For this moving average, we want it to be a period of 21. The MA method or the moving average method, we want it to be exponential. The style or the color of it doesn't really matter. For this purpose, I'm going to use like an aqua or light blue. All right. That's the first indicator we have. The second indicator is called a MACD. Just click on that page with the green plus again, go down to oscillators, scroll over till you see MACD for the MACD. All right, with this, you don't really have to change anything or do anything spectacular to it. I don't really like it on MT4, but just hit OK. The third and final indicator we're going to add, go back to your indicator list, go down to Bill Williams, and we're going to add fractals. Doesn't matter the color. I'm going to highlight these as yellow and then just hit OK. Now, since we have this set up, what we're going to do now is save this as a template. And to do that, all you would do is instead of going up here to the indicators list, go 2 spots to the right, click on the drop down arrow, save template. You can name it whatever you want to, but this is a training wheel and setup basically. It's to help help you train your eyes to look for certain stuff. Click save, and that's all you have to do. Now, let's say you wanted to trade something else besides the Euro USD. Instead of having to, manually add all those indicators or your indicators again, this is what your chart going to look like when you open up a new chart on MetaTrader 4. Come over here to the drop down under your templates, click load template, and then whatever you named that template, click on it, hit open, and voila, it's automatically going to adjust it for you. All right. So let's go back to the Euro. That is all I'm going to set up as far as the indicators for now. Okay. Let me see. I had some other things I had to go over. Yeah. All right. Uh-oh. Got it. Yes. Now we got to open up our MyFX book. All right. So to do that, go to myfxbook.com, click on it. Again, this is for tracking purposes, the contest, and to help you understand what kind of trader you are and your trends. You can sign up, you can open up your account with Facebook profile, it doesn't even really matter. But once you open up your account, you want to go to portfolio, add an account. You don't have any accounts currently, click on add account. Under the platform, you want to select MetaTrader 4 auto update. Okay. 500 broker account name. You can name it under broker. It's going to say please select and give you a way to search. You can just search it, type in JAFX. It's going to populate. Now again, the account number is what you use. These next two is what the information you used to log into the MetaTrader 4 that we took a picture of earlier. So just a second. Just hit create account. All right. So it's either going to tell us if it connected or what happened or what went wrong, basically. So we'll give it a few minutes. All right, hurry up. There's one. Oops. 7J. You all have any questions so far? Any other questions? All right. In a normal case, it would connect, but I don't know why it's not connecting to mine. So, anyways, once you all have that, let me see. Let me see if I can get it connect, man. This is terrible. Let's see. Let's do publisher. Nope. Dang, man, I don't want to use the EA. I like doing auto. Yeah, who had a question? Just type it in the chat box. All right, so I'm not gonna worry about setting this up tonight. I'll show you guys on the next class tomorrow. But so we'll set the MyFX book up tomorrow once I figure out what's going on, why it wouldn't let me do it tonight. So had we set it up, we would close out of everything, come back to the MetaTrader 4. Now, let me explain to you what these indicators are and how to use them, okay? These yellow arrows, they're telling you swing points of the market or swing points of the trend, okay? So if you're thinking it's going to be on a downtrend, then you're going to enter your order after the arrow appears at the top around the blue line. If you think it's going to be an uptrend, then you're going to enter when an arrow appears on the bottom, okay, around the blue line. So something like, so here's the downtrend. Notice the arrow, resistance, 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 come down, boom, right? On an uptrend, support, support, comes up, support, support. So as new folks for this contest, what we're going to do, without me giving you all too much detail for right now about the strategy and how to use it, what I want you guys to do is create your $500 demo accounts, okay? And basically trade it, all right? Just using these three indicators, okay? Even though you don't know much right now, that's fine, all right? Because what's going to happen is this contest is going to run for like the next, or this is going to run for like the next 4 to 6 weeks, okay? And this is going to track your progression from day one, not knowing anything or barely knowing anything, where you're currently at, all the way to the end of the course. And you should be able to see from day one to day 15 a huge difference in your trading. So remember, the arrows are going to form at your swing points. And of course, I'm going to go in depth over these indicators on another day. But again, this is just for day one. Yes, if you just say do a $500 account for this contest, the reason why I say 500 is because majority of folks can gather 500 to put in the real account as well. And learning on the $500 account is going to help you control your risk management as well. With the MACD is a momentum or a trend strength indicator. Basically, it's telling you if the bulls or the bears. It's telling you if the buyers or the sellers are in control. Whenever these hashed lines are getting shorter than, if this line is shorter than this one, this line shorter than this one, this line shorter than this one, that means momentum or the trend is looking to be a little bit bullish. And as you can see, during this consolidation, it's a little bit bullish, then more bullish than bearish. But when the red line's pointing down and you see the bars getting this bar long, this bar shorter than this one, this bar shorter than this one type of deal, you're looking for the short of the market or in the trend, okay? So starting out, guys, what you're going to do is on a very bare naked setup, all right? You're just going to click on this draw Fibonacci tool over here, click on that button, find the yellow arrows, and depending if you're looking to sell, you're going to go from high yellow arrow to low yellow arrow. If you're looking to buy, you're going to go from low yellow arrow to the high yellow arrow. So here's a quick example. If I'm looking at the euro and I'm looking to, what the hell? If I'm looking at the euro and I'm looking to, enter the market, basically, I'm looking at this right now, 4-hour chart. I see this bearish momentum, right? So I'm looking to basically sell. Okay, I'm looking for an opportunity to get in for the sell. I'm not going to get in my sell if I see the market down like that. That's just not very wise. If the market is already going the direction that you want it to go, it's not very wise to really enter, because there's going to be a pullback at some time. Okay, so if you're looking for the sell, you want to see the market pull back a little bit. Okay, so you take your fib tool, and I'm going to fib from this arrow right here, from that swing point down to the lowest swing point. Okay. And I'm going to let the market retrace in between the 50 and anywhere above the 50, but below the 100, you can look for an enter. Look for it to enter, okay? So let's say, But basically, what I want you guys to do is basically try to, turn some profits. Just can you all hear me? Is that better? All right, cool. Last thing we heard was 5,200. Yeah. So basically, enter anywhere between the 50 and the 100. All right, for right now. So on this short, you want to see the market go somewhere between the 50 and 100 around structure and to start stalling, looking like, and you're going to look for another arrow to basically form in between the 50 and the 100. If an arrow forms to the top and you're looking to go short, that's your entry mark. That's what I'm trying to tell you guys. So if it forms around the 382, that's your entry. That's what I'm trying to tell you guys. All right. And what this setup is, like I said, it's like some training wheels to help your eyes look for different swing points. Now, that's how you set it up on the Jax FX. Let's set up TradingView. I like TradingView way, way, way better. So for TradingView, this is what your chart's going to look like. All right, you've got a different MACD. You've also got some different fractals, basically. Okay, same moving average line though. All right. For TradingView, let's see. You can open up a TradingView account with your Facebook account, things like that, if you all don't already have it. But you open it up. You'll come. Let me choose a new chart. Damn, which one do I want to use? That's crazy. I think it's got to buy. All right. So let me exit out of this. All right. So when you all open up your TradingView account, your charts aren't going to look like this. Just basically bear. All right. Indicators we're going to add. Click on indicators. First one would be moving average, exponential. Click on that. The second would be the MACD, MACD 4C. All right. Click on that. Next would be fractals V5. Click on that. Exit out of it, okay? This is what is going to look like initially. So what we're going to do now is modify our fractals just a little bit. So what we can do is go to a fractal, you can right click on it, or you can come up here to where this eyeball is, and there's a cog to the right of it. Click format. On the default thing, guys, these two check boxes are not checked. All right. What we want to do is check the first one, filter out the Bill Williams fractals. Okay. We want to decheck show channel and decheck the zigzag, and then hit OK. And that's it. What that does is pick out the most important swing points that we really need to pay attention to. Next, go back up to the left-hand corner under the EMA 9. Go to the right of the eye, hit the format, change the length to 21. and then hit OK. And again, you're able to save this template if you want to by clicking on the drop down arrow to the right of the indicators, and then save indicator template as. Boom. Oh, maybe you can't do with the free version. I thought you could. Sorry. But so like I said, this is the basic training wheels strategy for right now. All right. These fractals work the same way as how I showed you on MetaTrader 4. This is your Fibonacci tool. So come over here on TradingView again, and just start playing with the tools, discovering different things, and just trading or doing your chart markups, and you'll find TradingView has many more resources and tools available for you at your disposal than MetaTrader 4. That's the reason why I like it. It's a little bit cleaner as well. Okay. Do y'all have any questions so far? I know Stevenson's about to hop on, I believe, around 10. Yeah. On MetaTrader 4, Elroy? Yeah. Let's see. So you go to indicators. See what you said real quick. Kevin, I do use the RSI every now and again, and of course that's in another lesson. We'll get to that. I'm trying to tell you guys, this course is pretty extensive, man. It's a lot of material. That's why I'm recording everything for you all to go back and rewatch. That's why I'm requiring you all to do some homework, so I know what's sticking with you and what's not. But for the fractals, go to the page with the green plus, click on it, go down to Bill Williams, and hit fractals. And what these fractals are doing, they're highlighting all the swing points for you. You guys are welcome. Now let me see. For the homework for tonight, guys, I am going to require you all to read one chapter. Okay, it's the first chapter. Exactly, Elroy. So you're exactly right. So if you're looking to sell, you're going to wait for this pullback to happen, and you're going to wait for a yellow arrow or a fractal to appear on the top side of the candle. If you're looking for the buy, then you're going to look for the retracement to happen and the arrow to appear below the arrow. I mean, an arrow to appear below the candle, and that's going to be your swing point. Oh yes, the homework. Let me show you guys real quick. Your homework is going to be very simple, very basic. It's not too much actually. Let's see. Let me pull it up real quick. I got lots of stuff for you guys. This is the PDF that you all need to download tonight if you all haven't. First chapter is trader psychology, basically, what to expect, okay? Individual psychology. So it's not too many pages. It's about, what's that, 16 pages, okay? So this chapter 1, individual psychology, you need to read from 4 to 10, basically. This is going to, change your mentality a little bit to get you off to think about trading in a different realm, basically, okay? It's going to set you up for success. This book has a lot of nuggets in it, and we'll be reading chapter 1. We will read parts of chapter 2. We will read part of chapter 4 on the MACD, moving averages, and the RSI. And then we will read on chapter 7, section 39, the triple screen trading system and the info system. And that's really about it. I would recommend you all coming down here to read the risk management and the good record keeping, because again, that's going to set you up for success. Any questions about that? About the homework? So review the homework. Read this chapter 1, individual psychology. Get your charts and things like that set up for next class. I posted the link. I'll repost the link again. Hold on. Boom. And that's how you download the book or the PDF, guys, okay? Excuse me. That's really all I have for you all tonight, guys. Like I said, tonight was just going to really set the tone, go over some very, very basics of things, help you all, we'll show you all how to get things set up and running and record this video for you all so that way you all can rewatch it. And then get ready for tomorrow, because tomorrow's when we really start, getting into the technical analysis and some more stuff in it. Alrighty, any questions? No problem, guys. You're welcome. No doubt, no doubt. Oh, tonight I will be sending out a signal or two for the compound plan. Okay. And I'll go over the compound plan tomorrow as well with you guys. But just be looking for me to send out a trade alert or two. Alvin, you might need to, yeah, you might need to clear up some memory on your computer or something. Tavoris, the compound that I have, it's you can compound basically any account or any amount. Hey Alvin, inbox me on Facebook. I'll have to help you personally. See if I can help you personally. All right. Well, guys, let's see. We'll stop it for tonight. I said it was going to be close to 2 hours. I kept you all for an hour and 45 minutes now. Appreciate you guys spending time with me tonight. Tomorrow it's going to get even better. But if there's no more questions, we can hop off right now and get prepared for Stevenson Linder's call if he's not already on. No problem, no problem. I'm going to get the video and the recording rendered and put up on YouTube and things like that for you all to go back and review. I know it was a lot of information I went over as far as even just the basics. So you all have a good night, and I'll send you all a trade setup or two here in a little bit.